This is the fastest decline in a stock market to the extent that we've had it, meaning the depth and the speed at which it's declined. There's only been one other time in history that really rivaled this pace, to decline almost 40% in a 30-day period.
Hey everybody, what's up? Welcome to Go Live. I'm your host, Joshua Scott. I've got Reese Harper with Dentist Advisors here with me as a guest. It's Wednesday. It's 2:00 my time. You guys are
high noon.
Yeah, high noon. So man, super excited to have him here. Reese is like, man, I feel like I see you at every conference. You've been speaking a ton.
Yeah, I have been prior to coronavirus, so that was good. My wife is like pretty happy right now in that dimension. She's like, I see you a lot now. This is good.
Yeah. Yeah, no, I mean, we've crossed paths a ton. We've never really talked a lot. I think at the last one, what was it? Voices of Dentistry. We chatted for a little bit. But obviously, I love what you guys are doing, and your company gets a lot of respect around the industry for sure.
Thanks a lot.
Yeah. You want to maybe give us a little 30 seconds on you and the company and when you started it and all that stuff?
We are about, I started in the industry working as a financial advisor in 2003. I worked for a larger company and wanted to go out on my own and try to build a different type of business model. And so I left that large company in 2007 and started what is now Dentist Advisors. The first few years I wasn't. Dentist Advisors was not the name of the company. It was called Acquire Wealth, and we worked with business owners, professional service providers like lawyers and doctors and dentists and some other professional services. And then we kind of decided, to specialize and only work with one occupation. And that's what's helped the company really become what it is now. And kind of our commitment to being a really narrow specialist, I think has really helped. And we've learned a lot about dentists, in times like this, we're able, as a financial advisor, rather than maybe being a little more generic and talking about only investments or only insurance or only things that are more broadly applicable, we're able to really, we have more value that we can offer. I think especially during difficult times like this, we, have expertise that's pretty narrow and relevant to what our clients are specifically going through with COVID and SBA financing, EIDL loans, the PPP program, human resource issues that they're dealing with. And those are kind of things that a wealth manager typically doesn't get involved in that much. And for us, that we just feel like the value proposition is pretty high. And hopefully during this time, we're able to help people in a way that, everyone's in a tough spot, but I think that having someone in your corner who knows the answers quickly and can save you time instead of having to go through 50 people to get an answer, it saves people a lot and helps them be a little more present and get through this time a little bit easier. So.
Yeah, that's a great point. Because I was going to say, my impression is that you guys are more consultative in nature. And so I would imagine during the time like this, you're probably doing a lot more than is even necessarily laid out, in what a normal relationship looks like, because you're just going above and beyond. Has that been true?
Yeah, if you go to on our dentistadvisors.com/COVID page, you'll find HR links, and you'll find tons of podcasts that we do and Facebook Lives that we're doing on this topic. And we're having weekend phone calls, night phone calls, early mornings. We don't really have set hours right now. Everyone's cell phone numbers are in every one of our clients' hands, and they're texting, and we're just really accessible. That's not common, but it's also not free. We are a premium provider of service. I'm kind of I would say we're accessible in terms of you don't have to have a lot of money to work with us. You just have to be willing to pay something. We have really simple models where people, based on their complexity, cost a certain amount of money. It might be $500 a month, or it might be $200 a month. But like we just have to, based on your level of complexity, you pay a certain amount, and then as you get wealthier over time, that sometimes that your complexity goes up, and sometimes it just stays the same. We measure complexity based on income and net worth and number of employees and assets and real estate holdings and business entities. And so if you're an associate, we've got a perfect model for you. If you're a multi-location like budding DSO, then we have a good model for you. And but yeah, like our conversations are pretty broad.
Yeah, I can imagine. Man, I would have saw you probably last weekend at Mark's event. I was assuming you guys would have been there for sure.
Yeah, I was excited. I had a really good deck planned, and we had like there was, a lot of people registered for that event, and
Yeah.
my heart goes out to Mark for how hard he works to put that together, and it's just a tough time for a lot of people. So
Yeah. When did you guys? When did you see this coming? Like, when did you think it was going to be a big deal? Was it a couple Mondays ago when it all just kind of hit, or you've been watching this for a while?
yeah, I mean, I was scheduled to go to London with my wife. We had a big anniversary trip planned, and we were going to do that. Our dates were like, I think it was March, like 13th and 12th.
Okay.
So like the 12th and 13th was, I mean, the day where you really knew it was probably going to go south, like when it was probably like the 10th or the 11th of March when you started like sensing it a lot domestically. I don't know that I felt anything like in the latter part of February that was super severe, because Wuhan was like barely starting to take off at that point. But the middle of March, I was scheduled to go to the Mommy Dennison Business CEO Summit.
Oh yeah.
That weekend, and I could, it was kind of melting down then, and that's when I was like, oh boy, this could be. I mean, it just when Delta's, when Delta is affected that much, like Delta stock today is probably, I don't know where it's at now, but it was like $24 this morning.
Whoa.
$25, and it's a $63 stock. It's down 60%. They're just their hold times on their phones were 11 hours.
Yeah.
The 12th or 13th. That's when I started getting like worried, because I'm just like, okay, if there's no travel and if there's no retail, like, or not retail, because at the time I didn't forecast like complete isolation, but if there's no vacation, if there's no hotels, if everyone's going to be canceling things, if I feel uncomfortable traveling to Europe, like I canceled my Europe trip like first part of March. Like it was like the first part of March when I canceled, and I thought I was just being real proactive.
Yeah.
Being like, yeah, it's not the time. This could get bad, and I don't want to get stuck with hotels I can't cancel. And it moved quick. This is the fastest decline in a stock market that, like the fastest decline we've had to the extent that we've had it, meaning the depth and the speed at which it's declined. There's only been one other time in history that really rivaled this pace, to decline almost 40% in a 30-day period.
Yeah.
That's really, really unusual. On the flip side, the government action is also unprecedented. $2 trillion is a lot of money. Like it's a significant amount of money. It's more than the 08-09 bailout. It's a significant contribution that they're making. The Federal Reserve and the U.S. Treasury is like able to borrow money still from other countries and create demand. Like it's not like they're printing all this money. The $2 trillion stimulus is not just the government printing money to create money in the economy. A lot of this, and they will if they have to, but a lot of this is going to be based on demand for our treasuries. People lend money to the U.S. government still, and they're willing to lend money to the U.S. government for less than 1% a year right now. And there's a lot of demand. There's a lot of demand for that still. And so, we're in a good spot in that sense. It's not like, a country that can't borrow money from other countries still. The government said that they will, you probably heard of fancy words like quantitative easing, and your listeners probably have heard of printing money. Printing money versus borrowing money is very different.
Yeah.
And right now, there's still quite a bit of demand for borrowing money from our government. And so, I don't know, the contribution they're making has created like a pretty fast recovery as well in the short term right now. I don't know what's going to happen over the next 12 months. And I really don't trust people that forecast with precision.
Yeah.
But anyway, I brought that up just because it's been a really unique time with a very steep recovery and a very steep decline. And a lot of people feel like, if there is a vaccine and if this burns off in the next couple of months, we could have the whole market back by the fourth quarter.
Right.
That's just really unprecedented speed, of moving a capital market that quickly. There'll be a lot of damage from this. There'll be some additional national debt. It was a costly, a costly virus, and hopefully, we learn a lot from this about how to try to prepare for things in the future so that our country isn't so caught off guard, and maybe economically we're more resilient in the future by adjusting our markets a little bit to the fact that this could happen again.
Yeah, that's what's interesting to me is round two, in a couple of years or whatever, up and coming virus pokes its head out, and like, how are we responding? I think it's interesting too, because I've heard people say this, and I agree with them technically, but people say we're not technically in a recession yet. This is a public health threat that we're dealing with. A recession is going to come, most likely. And today I was reading an article on like the shapes that those recessions could take, like whether it's an L, whether it's a V. Some people are like, it's a W, like it could be a W right now. Like, what do you think about that when people say it's not a financial recession yet? Truth?
Well, they're just defining the term. Like, for example, like the term bear market, like technically that means a decline of 20% or more from the peak of a market. So,
yeah.
And a correction is 10%.
Yeah. But isn't that even over time? Like, is that a month or 2 months, or it's like 2 quarters or something?
Anytime the stock market goes from its peak to a decline of 20% over any period,
okay,
right, that would be considered a bear market.
Okay.
But and so the stock market always reaches new highs because companies are always growing, and so anytime you recede from a peak, then there's certain definitions that people will use to call it a bear or a bull or a correction. A true recession has to do with a decline in gross domestic product, or a decline in things that the country makes, a decline in goods that we produce. And it isn't related to the stock market move. So you could be in a recession, but a recession can happen independent of a stock market decline. And so even though the stock market's declining right now, there just hasn't been quite enough time passed to say we are in a recession.
Yeah.
And so technically that will happen as soon as the volume of stuff that our country produces declines at a rate that puts us into recession mode. And then depression is even worse than a recession, and a deeper decline in the goods and services we produce. So the number of cars that we sell, the number of computers that we manufacture, the number of the loaves of bread that we sell, all of that stuff, the decline in that causes a recession. And so technically we're not in one yet, but we will be as soon as we have enough economic data to measure that.
Yeah.
It's likely that we will be. It's not a fact yet, and we don't know exactly how the stimulus package will cause the country to kind of jumpstart. It's a big package, and they're hoping that it will cause the country to stabilize, and that we will just lose out on 5 to 6 weeks of gross domestic product. Gross domestic product is the amount of stuff we produce that I was talking about. And $2 trillion is basically what the country produces in about 5 to 6 weeks.
Okay.
So if we're shut down for 6 weeks completely,
I see.
$2 trillion into the system, there's a chance that we might actually not recede. and
Yeah.
that's the hope of the central bank.
Yeah, gotcha. And by bolstering unemployment and giving it to small businesses to maintain salary, then you're maintaining people's incomes, and then they keep spending the same, and that puts it right back.
Yeah, and that's very different than what happened in '08 or '09, where the money wasn't given in unemployment or payroll reductions.
Right.
It was given to banks, and it was given to large financial institutions, and then those institutions sat on the money for quite a while and didn't lend it out because they were scared that they would run out of money.
Okay.
So as opposed to this stimulus package, this is literally like payroll, and everyone's getting $1,200, and everyone's going to get paid for 2.5 months, and businesses don't have to pay this money back. They're going to try a different package as opposed to giving it to the financial institutions. They're giving it to the lender, or they're giving it to the small business community, and then they're lending money to a lot of industries that have been hit, like
right, airlines.
And so we'll see. Like, it's a different approach, and it's a very different stimulus package, and it should have a more direct effect on the economy. There's always a cost for doing something like this, and I'd hate to be the person that has to make these kind of decisions. It's a difficult choice when you're adding national debt, but you're also trying to avoid the cost of going into a recession, or the cost of going into a depression would be much more severe than the cost of adding to our national debt. And so,
yeah, and that's true. It was almost like when the details were first coming out, especially earlier in the week, late last week, it was almost like, I mean, there was this like too good to be true part to it. And, you're talking to clients, and it's like, it just seems like the government's throwing money at this. And you're like, is this really what's happening? But, and we'll see when we get into it. But I think it's exactly what you said, of just put the money in the hands of citizens, of businesses, because that will maintain the economy during that time.
Yeah, it's just making up for what we lost during the period where everyone was shut down, and we're seeing if we can kind of not harm people because of this virus, then the economy was already at an underlying a solid position. I mean, a lot of my clients' best collections month in like 10 years was, February or March before they shut down, and then it's just like off.
Yep.
So I think the approach that they took was, for how fast they responded, like I felt like it was pretty measured and thoughtful and creative. It's definitely a very unprecedented response, but I feel like I feel optimistic about what could happen if the virus doesn't morph into another strain that causes us to have a new vaccine that we have to create next year. I mean, as long as this isn't something that we can't figure out medically, then I think we'll be able to get through this.
Yeah. We got definitely a bunch of viewers on live. Hannah Coffee says hi. Shannon Paris, hey. Got a question actually from my wife. She says, how long have you guys been married?
Me and Barbie?
Yeah.
So me and my wife were married in 2003, in December 27th. So it'll be, that would be, I don't know how many years that is now, because that's almost, is that
17 coming up?
18 coming up? Yeah.
Something like that.
Yeah. We do like 5-year, the 10-year, the 15-year, and the 20-year. And I know it's not the 20-year yet. It's past 15.
So you're on a range. And you guys have some kids too, right?
Yeah, we got 4 kids. They're running around here in the house. I'm at home and quarantining, and just there's 4 of them, and I have a blast with them. We live close to the mountains. You can see outside of my office window right here. Maybe you can see the mountains. I don't know if you can see that.
Oh yeah, for sure.
Yeah, they're putting grass in my yard right now, but I live like right at the mouth of Big Cottonwood Canyon.
Okay, yeah.
Salt Lake, and I go up, I'm up in the canyons every few days. So every couple of days I'm up there, riding my bike, skiing, hiking, just going along the river. So there's a cool river that runs down the mountain. It's pretty awesome. And then, in Salt Lake, there's like 4 canyons right here, and Big Cottonwood's the one I live by. So I enjoy it.
Nice. Yeah, it looks beautiful. Well, look, let me ask you some financial questions here because I know you guys you're in the middle of that. But then I told you when we got on beforehand, I want to also ask you about some content strategy creation
Okay. Yeah, let's do it.
questions because you spoke at Jumpstart on that earlier this year and it was awesome.
You gave them a lot of financial stuff, so I'll try to go quick on that. I don't want to bore people. I don't want to bore people too much.
Yeah. No, but I mean, so obviously I'm sure this is creating all kinds of questions for your guys' clients. What have been some of the most popular? I know probably just how you deal with cash on hand versus debt right now is probably one of them, but then also effect on retirement plans, investments, like strategy there, short-term, long-term. What are you guys seeing a lot of?
Well, I would say right now, like most everyone at this point you got to make a decision by today if you're going to furlough or lay off, your employees and put them on unemployment, or if you're going to kind of let the new laws take effect and kind of deal with the FMLA stuff. And most people probably, if you haven't read or aren't updated on this, just go to dentistadvisors.com/COVID, COVID. And on that site, I have like a lot of Facebook lives on this, but general summary would be your action plan right now is first, document your HR strategy, not just like make choices, but you have to document why certain people were the people you kept and why certain people were the ones that you furloughed or laid off or terminated. And it has to be rational, meaning like there has to be like a function, rationale, not just like a preference for compensation or any kind of targeting that is based on family situations or complexity of, the COVID in someone's family. So you just got to make sure you document your strategy and write it down. And I would consult like a good HR professional, like HR for Health is solid, and cedrhealth.com. Both of those are good dental specific kind of human resource firms. And then you get a local attorney if you want to document it. At this point, it's a little bit late for all that, and I don't want to overwhelm you, but like that's probably what should have happened up until now.
Yeah.
And then second, you've got to decide on your financing strategy. And there's really only like two main options right now that are government packages. There's the EIDL loan, which you can apply for on the SBA's website. That loan is that loan is not going to be the most common loan that people will apply for. It allows for a $10,000 grant if you're approved. It also allows for financing that you have to pay back at 3.75% interest over 30 years. You can be approved for up to $10 million in that program. It's not likely that you would be. It's most likely that most of you will get approved for what's called the PPP program, which is the one that was instituted by the new Congressional CARES Act. And that PPP program, you won't be able to apply probably till Friday of this week. On Friday of this week, the SBA applications will finally be available. You apply for this through your local banker. This loan is given to you based on 250% of your monthly overhead payroll expenses, or 2.5 times basically your monthly overhead. This includes things like payroll for yourself, for your spouse, for any children that are on payroll. It includes all team. Includes administrative expenses for employee benefits like healthcare and insurance and 401ks and all your defined benefit plans if you have them. It also covers rent and a few other payroll related expenses. Those things you'll get a loan that's going to be required to be paid back over 8 weeks from the time that you are receiving the loan. Not from the time you apply, but from the time you get the money. And this period only goes in through June 30th. So what we're trying to do is encourage people to get people back to their offices and working as soon as possible and spend the money as quickly as possible and not spread it out or hold on to it. So you've got to spend it in 8 weeks, and that's what you'll have. It's my understanding at this point that you'll be able to apply anytime between now and June 30th, though, and get that grant. So it may or may not make sense for dentists to accept the loan right away if you're still 4 to 6 weeks out from being open. You might want to consider having your beginning date as soon, if we can even control that. It looks like we'll be able to control. I mean, I'm assuming at this point you'll be able to control when you sign the final paperwork to say, I want the loan. So you could defer that signature for a few days. There might be on the application a date that you want it to begin. They might not allow that. It might just be date of application, and we'll roll with it. There's just a few details that we'll know on Friday as soon as they come out.
Yeah.
But those are the two main like government sponsored programs. In addition to that, I would encourage people to apply for non-SBA funding, meaning a line of credit from your local bank that is not tied to the SBA financing, so that it doesn't reduce your amount that you can borrow from the PPP program.
Yeah.
And also, I'd encourage people to borrow or sign up for home equity lines of credit on their property if they haven't already. So you have a home equity line, you have a business credit line, plus the PPP program, and then the EIDL loan that you can get some financing for non-payroll related expenses, and you can get the $10,000 grant from that program. It just will offset the amount that you can get from the PPP program, the 10 grand that you can get from the EIDL. And again, if you just go to dentistadvisors.com/COVID, you can like read more about this and hear more webinars on it.
Yeah.
And then the last thing I would say, step 3, is preparing your portfolio or preparing your liquid assets or any reserves that you have for possible liquidation.
Okay.
And in case you need to go there as well, right? And so when you look at your stock portfolio, like if you're every person that has a stock portfolio has bought shares at a certain price over the last however many years. If it's in a mutual fund, maybe you've been buying shares of this mutual fund since 2011 or 2010 or 2013. Maybe it's just been since 2018. Either way, when you liquidate a portfolio, a lot of financial advisors don't have a lot of investment experience. Your money's being managed by someplace else, and they're just kind of the broker.
Yeah.
And a lot of times that will result in them doing things with your portfolio that maybe they unintentionally didn't realize that was disadvantageous for you. Meaning sometimes if you ask for $10,000, they might sell your most recent purchase of $4,000 that you bought, 2 weeks ago, and give you that money. That would be like the worst shares to probably give you. That you want them to go back and actually liquidate they call them lots of securities. Every time you purchase, there's a lot, and that lot is tracked by the custodian, and you can say, I want to see my financial advisor show me my history of unrealized gains in my portfolio. So you want to see, in 2012, I bought $10,000 and it's still up 52% from the bottom, right, when I bought it. So that bought is different than the one you just barely bought from 2 weeks ago that might be down 35%. And you can make choices in your portfolio to offset you can sell things that are old and aren't down, or you can sell stuff that's new in order to take some losses to offset gains from an older purchase that you made. So for example, if you speculated on a stock in the last couple of years and happens to be down, or you bought a mutual fund that's down a lot, you might want to sell some of that and sell some of the stuff that's up in order to offset the taxes, so that you're kind of in a tax neutral position across your portfolio, and then withdraw your $10,000 out. A lot of our clients have not yet had to withdraw money, and some of them are still contributing, and they probably wouldn't be able to contribute for many months more if this persisted. But a lot of people are still trying to invest right now because the prices are kind of once in a decade kind of lows.
Yeah.
But when you liquidate money, you just need to be careful to liquidate from the right part of your portfolio and the right date of purchase of a lot of securities. This is particularly important inside of accounts that are we call them brokerage accounts or after-tax accounts, not your 401k or retirement account. And because inside of a 401k, none of this tax stuff really applies in terms of withdrawing. You're going to pay penalties and taxes if you take money out of a 401k. And this has more to do with your money outside of a 401k. But we are still, a lot of people are investing right now, if they had a little bit of extra cash they've been holding on to for a few years and just never really got around to it. But, that's the minority of people. Most of our clients in particular have been investing all the time. And so, they weren't hoarding cash to then wait for a moment when the world imploded to invest. And so most people are just, this has been such a quick decline and a fairly, quick result after the stimulus package. We're still down a fair amount, but we're, the opportunity for like the fire sale prices only lasted like for like a week. It's still a very good discount off of its highs, but markets like this just move so fast. That's why I generally encourage people not to speculate, over short-term moves like this.
What do you, going back to, home equity line of credit, business line of credit, PPE, SBA loan, all this stuff, the reserves that you have, what's been your advice with strategy? Because I think like, depending on how long this goes, like, people blow through reserves and then they're into a PPP program and then tapping a line of credit. Like, do you have any advice on like kind of staging that out and being conservative about how long this goes, or is it just survive at all costs?
Well, our philosophy is we have a KPI we call liquid term, and it measures, it's a factor on my periodic table here. It's this thing. This periodic table of finances is 12 indicators that we monitor for clients in order to know what they should do when they ask a question. So if somebody asks me that question and they only had a 1 LT score, I don't want to say only, but if they had a 1 LT score, what that tells me is that they can live about a year right now. Personally, they can last for about a year without dipping into anything else because they've got this liquidity or access to capital of a year. It doesn't all have to be in the bank. It could be in a mutual fund that they can get access to it, in a day or two.
Yeah.
But if somebody's got like a 2 LT score or a 3 LT score, I'm just not that like worried right now.
Okay.
What that means is they've got like 2 or 3 years worth of personal living expenses they built up. And I have a lot of clients in that situation and they're still stressed, but like, it's easy for me to like calm their nerves and fears and just say, look, you've prepared for this. You've done really well.
Right.
We generally don't like people paying down debt at all until they've built at least a 1 LT score. So I don't even recommend people pay off their student loans until they've got a year's worth of liquidity. I don't like paying off my house until I've got multiple, like I personally haven't accelerated my personal mortgage payoff at all beyond my normal 30-year schedule. And I probably won't ever accelerate it, but I am building my LT score quite high. Like I would prefer to have enough to pay off my home liquid, but never pay it off still. Like I never would pay it off. If you have a crisis like this and the government starts printing money and all of our assets are devalued, if the government said they're not doing this right now, but like to raise $2 trillion, it's a lot of money. And a lot of times the only way to do that is put more money into the economy by creating it electronically. There's another $500 billion now just available in the market. And that makes each dollar that you have be worth less. And it causes the prices of things to go up. And so housing, for example, is something that if the government prints a lot of money, right, the cost of homes also will inflate or increase. And if the government prints a lot of money, it costs more to buy a car, it costs more to eat, it costs more to. So in my view, it's safer to maintain high amounts of liquidity, meaning high amounts of the dollars, and keep them invested in a conservative way for at least a year or two's worth of spending. But beyond that, even money in the stock market for me is liquid. I can get at it. Yeah, it might be down 20% if I had to get it in a particular week or if I was forced to liquidate it. But that's why I keep my year or two's worth of liquidity in the safe stuff so that I don't have to be forced to take it out of the stock market. But I'd rather have money in a liquid market than pay off debt in a world where the government is continually making the stuff that we own just cost more and more and more, because it doesn't really help me pay off my loan. They're essentially making my loan less attractive to pay off because it's not, the interest rates are not extremely high, and every time they print money, it devalues the things that we're paying for. And so I'd rather have the ability to like protect myself during a tough economic condition like we're in right now, because the only way that you can survive and thrive and your listeners know this, is by continuing to grow your business and grow your enterprise and like have control over your destiny. And you can't do that if you don't have any liquidity, if you don't have any cash, if you don't have any accessible investments that you can just liquidate quickly. And so I prefer having a very high amount of liquid accessible cash. And so, yes, I would be using my loans right now as the priority, and I would not be tapping my liquidity at all. Like,
Gotcha.
this is the point where I would rack up whatever I needed to rack up in debt. And when I'm done with this whole crisis, I'll pay it off if I end up having plenty of cash at the end. But the interest I pay along the way is a very low price to pay for the peace of mind that I have by having lots of liquidity available, you know? And
yeah. Oh, that's helpful. That's helpful.
I'm a big fan of liquidity. I'm just not a big fan of like accelerating debt reduction as a business owner. If you could qualify for both the EIDL loan and the PPP loan, they could give you $10 million at 3.75%. I'd take every penny you could get. And if you're a large DSO, you've got a shot. If you're an average practice, you know, the economics, you're just not going to get that much in lending. But get as much financing as you can. You can always pay this off. Just keep it and sit on it and prioritize your liquidity. Because if this lasts longer, the people who have the last remaining dollars are always better off than the person that has the paid off house.
Yeah. Yeah. No, gosh, that's so true. Well, and it isn't like the case for it too, like the compound interest that, you know, if you've got X amount of dollars and you can pay off your house or you can invest it, at some point that compound interest that you're making on that investment far outweighs what you would have saved paying off the house. Is that right?
Yeah, no, that is correct. And a lot of financial advisors who are paid exclusively to manage your investments too will like overemphasize that fact. Like, that is true. It is true.
Okay.
And the math of compound interest usually outpaces loans. But if you run just a math formula like side by side for a lot of people, a student loan at 7%, like it doesn't actually, it's hard to make 7%.
Yeah.
Student loans aren't tax deductible. Student loan interest is every year. 7% return is kind of a wavy line in the market. Yeah. It's not like a straight line 7. So you won't always be ahead of the game from a math to math perspective, but you'll always be ahead of the game in terms of your ability to control your destiny. Your ability to take like if you have $100,000 right now, let's say you got two people, one person has $100,000 in the bank and a $400,000 student loan, and the other person has a $300,000 student loan but no money in the bank. Which one would you rather be?
Right.
400,000 student loans at 100 or 300 and no money?
Yeah.
The person with $100,000 has a chance to pivot jobs, move locations, get a better job, start a practice. You know, they can buy a home. Like, they can advance their life. They can like do things that you couldn't even fathom possible. Like, you could take a once in a lifetime trip and actually enjoy their, like sometimes a trip once a year is all it takes to like keep people feeling like sane.
Yeah.
Rational and being like, feel like their life is decent. You know?
Right. Yeah.
And so part of this to me is like, my vision is like a world where people make really good financial habits. They build good financial habits. We call them holistic financial habits.
Yeah.
And we believe that those habits lead them to live more present in each day. Our exact corporate vision is a world where people embrace habits of holistic financial health and live their present lives to the fullest.
Okay.
We want people to like just live life, like embrace your each day, embrace the moment, like enjoy each year. Like, all this stuff, like all this money, it's all just like, it's all made up stuff. Like, it's just fake paper that we're printing, and you just have to use it.
Yeah.
You have to use it to like live your best life. And your best life is preparing for the future, living a little bit in the present moment as well, you know, not putting your future in jeopardy. But it's not like, there isn't like a black and white, if this is 7% and I only make 6 over here, then I'm going to pay down the loan at 7. Liquidity trumps the exchange. Like what price can you place on someone's ability to maybe start a practice? practice? Like, what price could you pay for that?
Yeah.
Like, what interest rate differential is that worth? Is it worth 1% or 2%, or is the liquidity worth like 10 times? You know, in terms of, let's say you have the net worth of, both people have a zero net worth. If a person has 100,000 and another person has nothing, you know, like what price would you be willing to pay at 35 years old for that liquidity that gives you the options of taking a better job, or starting a practice, or investing in your practice, or marketing the practice more effectively, or growing your revenue? Like, if 100 grand is the reason that your income is twice as high as the other person in a couple of years, you know, now if you don't take advantage of that money, if you don't do anything with it, if you don't pursue growth, then yeah, it didn't do you any good to have it. And you should have paid off your student loan. Like, if you're in the same job, doing the same thing, doing the same activity, then you should have paid down the student loan, because you'd have at least been up a few $1,000s in net worth.
Yeah.
The person that kept it. But what I find is that most people in their lives, especially in moments like this, whatever the cost of liquidity was, even if that was a 5% mortgage that they had to get,
yeah,
you know, they just have options that other people don't have. And so I'm just like a big liquidity advocate.
Okay. So I love that. So if a practice owner right now, we're going in the next couple months, and they've got these options. Let's say they've got 100 grand in reserves. Then you've got a small business line of credit, and then you've got this PPP program coming in. Obviously, take the PPP program to offset wages and all that. But if between the reserves, 100 grand in reserves or 100 grand line of credit, you're saying use the line of credit because liquidity is worth so much more.
Yeah. Yep. Yeah. Liquidity is worth 2.5 times the interest expense on a debt. Like, it's just, what price can you pay for not going bankrupt?
Yeah.
What price would you be willing to pay to keep your practice?
Yeah.
You know,
yeah.
Like, that's why credit is so expensive in certain markets, you know, in certain times in life. You know, there is a price to pay for liquidity. One illustration of this is an interesting illustration. I know this is a complex concept, but like, a company that's private, when it goes public, the immediate jump in its stock price is it happens in almost every circumstance within a very short period of time. There's an immediate increase in a company's stock price when it goes public. Sometimes bad companies decline, like Pinterest dies, where Zoom video conferencing, like we're using, continues to rise because it's a better quality company. But there's an immediate premium that most companies get right when they go public. And the reason they get that premium is because they're providing liquidity to the marketplace. They're providing the ability for the whole general public to convert, you know, their capital into cash, and move it back and forth. That liquidity premium is the reason that a lot of these, that's the reason why there's a jump initially in stock value. And you're providing liquidity for the employees of that company that are going public to be able to get some of their money out finally, because they've been waiting for 10 years to get paid. You know, but the public's also willing to pay. So everyone's willing to pay a little bit of a discount to get access to cash. And it's just important to like remember that like liquidity really drives a lot of financial decisions. It drives stock values, it drives business opportunity, it drives your ability to invest and expand, it drives your ability to hire the right people. And so bearing the burden as an entrepreneur, bearing the burden of some debt is usually the cost of like growing the asset that you're in charge of, this business. And you have to bear that debt by bringing on partners and having them bring capital in, or you've got to borrow money to do it.
Yeah.
And both are fine ways, you know, but debt's a lot cheaper than stock and so that's probably like, people need to join my student learning class to go into that topic. That's a little too much. Okay. Go to advancedadvisors.com/student learning. We have a course you can just tune into. It's once a week. You pay $29 a month. We're doing it for up to the first 50 people. I think we're almost full.
Okay.
But you just sit and you learn, and you're going to most people don't want to learn all this stuff, but some of you might, and we're here to educate if you want to learn. So.
Yeah, no, I love that because I think that's a question I've been hearing a lot, and I think a lot of people get scared of debt and almost like, well, if we survive, but we've exhausted these lines of credits and these loans, like what good is that? So I think your perspective was fresh on that. Dude, I've just got a couple minutes left with you, but I wanted to kind of hit this topic of content creation, because one of the things I really like about you guys and you in particular is creating this value of creating content. And I was in one of your workshops at Jumpstart, and you talked about this. I forget who. Oh, you were speaking with Mark LeBlanc.
LeBlanc, yeah.
Yeah, and I loved your whole model of creating content, and basically you going, this is something I do on the regular, and here's how it looks. I mean, we've been a content creation company kind of from day one. That's been our marketing strategy: is less ads, more content, more education, more consultative advice. So tell me how that's played into your guys' company, how you kind of came to that value, just personally.
Well, I think personally, I'm like an educator at heart. You can probably tell from like the hour we've spent together. A lot of the things I'm interested in is like getting people to learn concepts and helping them get mastery over difficult issues like that are hard to learn. Most people, like if I was trying to market, I would just be talking about like, get your life back, live in the moment, like enjoy life. Like, let's take a vacation. Let's find that dream. Let's save up for that, second home. Like there's a lot of like emotional triggers that like are more motivating than like learning things. And so, it's hard sometimes to find that balance between like, I know the real key to financial wellness is like people learning concepts and learning concept mastery, but it's kind of like boring stuff too. So people aren't like that interested in it.
Yeah.
So we've had to like try to experiment with how to make things accessible and interesting, because my MO is just like teaching people how to that's our corporate mission, man. We have a mission statement and a vision statement. Our mission statement is to design and uphold the universal standard of holistic financial health. And we do that internally with technology. We do that with content. We do that with education. And everything we're building is focused on getting people to a place where they're more independent, they're more solid in their mindset, and they're living that present life like we talked about in our vision statement earlier.
Yeah.
So it's really due to a good team. Like all of our team is bought into that vision. Everyone's an educator. Everyone's sharing content. Everyone's helping create content. I don't know, I think that most people just realize that's probably where the world's at too. But for us, it's been more authentically we know we're not going to be able to service everyone in the world, but we can make a difference through like one piece of copy, one paragraph, one insight. Like somebody listening today to this is going to get something out of this that's going to help them in a meaningful way.
Yeah.
And that's enough for me to do it. That makes life worth living for me. If I know that one more person is in a better spot because of the time I took, I think that's going to be, that's the type of world we want to see exist. And so our whole company is really behind that mission, and our technology and our service offering and everything. Like we have just education training, like for finance. We also have services, for people that need help. We also just have like an app-based, like self-directed program, for people like put their stuff in and like get organized and then like just get a little bit of help as they need it. Like we're trying to create like a very broad way of getting help. And I think that's very different from, what you'll see from a lot of wealth management firms, where their goal isn't really, their vision's not as big. And so they're really just trying to target the wealthiest people.
Yeah.
And get them to pay them the most. And even if they're not that way day one, that's eventually like where they get to, because in order to raise their incomes, they've got to just charge more to fewer people because they don't want to manage a big enterprise, and it's a pain to hire people. And so, anyway, we're not perfect, but we care a lot about content. So
no, I love that. I think we share that value, because I am, I feel like you may have started a business this year or 5 years ago or whatever, but there is a sense of, if you own a business, there's part of it where it's like you're a media company now. And I think social media has done that to us, where like if you're not producing content for social media, you're getting further and further left behind. And so I think, especially with us, I don't know if you guys have run into this, but dental marketing companies don't always have the best reputation. And so I think for us, like we could have came into it like, oh, we're the best dental marketing company, best SEO, number one SEO, like all this stuff. But I was like, nobody trusts that anymore. So why don't we come into the space and be educators? And I have a real value of mission of wanting to elevate the industry as a whole on the marketing side, because I think it's been so bad.
Yeah.
So that's just been kind of our mission is like, hey, let's teach, let's educate, let's get people to follow. I mean, I'm real open with other dental marketing companies too. I have great relationships with them because I'm like, it's going to take all of us, man, to really do this,
Totally. Yeah. And I just, there's plenty of customers for everybody to be able to there's just a lot of customers out there for everyone. And so I think the more that, you do try to just move people in the right direction, selflessly try to teach and help them make good decisions, I think the better off the whole market and whole world will be. So I think that's great. I'm glad you guys, I've been impressed to see all that you guys have been doing too. So
yeah. When I talk to those other dental marketing companies, I'm like, look, here's like my talk with them. I go, there's 150,000 dentists in the country. 1% of that is 1,500 clients. I'm like, that's a massive company off of 1%. Yeah. So like, I'm not competing with you. Let's all go get our 1%, no big deal. So
totally.
Well, good, man. Hey, look, I appreciate you jumping on today. I know you are ultra busy, and taking this time is no small thing. So I really appreciate it. You're somebody I wanted to have a conversation with, especially around this. There was like an HR company and you, and I was like, I'm sure you guys are working nonstop right now, just dealing with client issues and calls. And so I appreciate it.
Let's get back together again in a few months and talk just content. We didn't get a chance to touch that as much today, just given the environment that we're in, but I'd love to talk more about that at some point. So thanks, Joshua. I really appreciate you taking the time.
Yeah, if we do that, man, we'll have to get a little Post-it board behind you and you can draw out your diagrams and all that stuff. It'd be fun. Hey, if people want to get in touch with you or learn more about what you guys do, where's the best place to connect?
I would say the first thing to do is go listen to our podcast at dentistadvisors.com/listen. Just go download the Dentist Money Show, each week, episode on Wednesday. That's where I would start. Of course, you can always book a consultation to kind of evaluate whether you'd like to become a customer. That's anywhere on the website at dentistadvisors.com. There's buttons all over for booking a consult, and just find that button and pick a time that works for you. Most of you are probably going to want to learn a little bit more, and that's where I'd recommend just jump on that podcast and listening to what we're saying there.
Yeah, cool, awesome. Yeah, check these guys out. I really respect Reese and what he's doing, and do appreciate it.